On June 17th, 2026, the most powerful financial institution on the planet held a meeting, made a decision, and then did something that has not happened in this exact way in the modern history of American central banking. The Federal Reserve kept interest rates exactly where they were, 3.50% to 3.75%. And then its brand new chairman, a man named Kevin Warsh, stood up in front of the entire financial world and simply didn't tell them what happens next. No rate path, no projection of his own, no dot on the chart that every trader, every economist, every pension fund manager on earth uses to plan their next move. For the first time since the Fed started publishing that chart back in 2012, the person running the show declined to participate in it. And I want you to sit with that for a second. Because in a world where the Fed usually can't stop talking, where every comma in every statement gets picked apart by 1,000 analysts, the silence itself became the loudest thing that happened all month. So here's what's actually going on. Why the Fed just went quiet at possibly the worst possible time to go quiet, and what it means for your money, whether that money is sitting in a 401k, in stocks, in a savings account, or in something a little shinier. Because I promise you, this isn't some wonky inside baseball central banking story that only matters to people in suits on Wall Street. This is about to touch your mortgage rate, your grocery bill, and whether the thing you've been saving for retirement is quietly losing value while you're not looking. Let's start with the basics, because I want everyone watching this, whether you've followed the Fed for 20 years or you've never thought about it once, to be able to follow along. The Federal Reserve, the Fed for short, is the central bank of the United States. Its main job, at least on paper, is to keep prices stable and keep as many people employed as possible. It does that mostly by setting something called the federal funds rate, which is basically the interest rate that banks charge each other for overnight loans. That one number ripples outward into everything: your credit card rate, your mortgage rate, the interest your savings account pays you, even how expensive it is for a business to borrow money to open a new location. When the Fed raises that rate, borrowing gets more expensive and the economy cools off. When it lowers that rate, borrowing gets cheaper and the economy heats up. Now, here's the part that actually matters for today's story. For the last 14 years or so, the Fed has done something on top of just setting that rate. It's told everyone, in advance, roughly where it expects that rate to go over the next year or two. That's called forward guidance, and the tool they use to do it is something called the dot plot, a chart where every single Fed policymaker anonymously places a dot showing where they personally think interest rates will be at the end of this year, next year, and so on. Investors love this thing. Wall Street builds entire trading strategies around it. It's basically the Fed handing out a partial answer key to its own test, on purpose, because the thinking was if markets know what's coming, they won't panic and overreact when it actually happens. And on June 17th, Kevin Warsh looked at that entire system, 14 years of central banking tradition, and effectively said, not for me. He didn't submit his own dot. He let the statement come out shorter and more bare bones than it's been in years. And behind the scenes, he's launching a full task force to rewrite how the Fed communicates altogether, along with reviewing how much the Fed leans on economic data, how it thinks about inflation, and even how artificial intelligence is reshaping the labor market. This isn't a small tweak. This is the new head of the most important financial institution in the world, walking in on day one and pulling the emergency brake on the entire communication playbook his three predecessors built. Okay, so why does that matter? Why would the guy in charge want to say less instead of more? Let's go through the reasons, because there are at least four, and they stack on top of each other in a way that should make you sit up a little. Reason number one, this is deliberate, and it's ideological. Kevin Warsh has criticized the dot plot for years, going back to when he sat on the Fed's own board of governors in the 2000s. His argument, in plain English, goes something like this. When the Fed tells markets exactly what it's going to do months in advance, it locks itself into decisions before it actually has the data to justify them. It's like a captain announcing the exact route of the ship 3 weeks before checking the weather. Warsh wants the Fed to react to what's actually happening in the economy in real time, not to a forecast made months earlier that might already be wrong by the time it matters. So dropping the dot plot isn't an accident or an oversight. It's the first move of a chairman trying to remake the entire institution in a different image. Reason number two, the statement itself got radically simpler. Where past Fed statements ran long, hedged, and layered with caveats, the kind of writing that takes a financial journalist 20 minutes to parse, this one was short and blunt. focused almost entirely on the phrase price stability. One market commentator described it as the Fed moving from long-term forward guidance toward a purely data-reactive posture, meaning don't ask us what we'll do in September, ask us in September. That sounds simple, even reasonable, but strip away the certainty markets have leaned on for 14 years, and you get one guaranteed side effect: more volatility, bigger swings. Markets that used to know what was coming now have to guess, and markets that have to guess tend to move harder and faster in both directions. Reason number 3, and this is the one that should really get your attention: the silence isn't coming from a place of confidence. It's coming from a place of genuine, deep disagreement. According to the minutes from that same meeting, the Fed's own policymakers are split almost down the middle. Half of the 18 officials who contribute to those old projections now think the next move should be a rate hike, not a cut. A complete reversal from where Wall Street had its money a year ago, when firms like Goldman Sachs were confidently predicting 3, 4, maybe 5 rate cuts by now. Instead, the Fed's own forecast for core inflation, using their preferred measure, has been revised upward to 3.3%, well above their 2% target. And their unemployment forecast has ticked up too, to around 4.3%. That's a strange, uncomfortable combination: inflation and unemployment both drifting the wrong way at the same time. Economists have a word for that environment, and it's not a fun one: stagflation adjacent. And when the people setting policy are that divided about which danger is scarier, inflation getting worse or the job market weakening, sometimes the easiest thing to do is say less, not more. Silence isn't always strength. Sometimes silence is what happens when the room can't agree, and nobody wants to be the one whose name is attached to a guess that turns out wrong. Reason number 4 ties directly into what institutions are doing with their own money right now, which we're going to dig into deeper in a bit. But the short version is this: at the exact moment the Fed is pulling back on giving markets certainty, the bond market is doing something the Fed presumably didn't want. Even though the actual interest rate didn't move an inch, the yield on the 10-year Treasury bond has climbed to roughly 4.53%, a noticeably higher level than you'd expect if markets felt reassured. A bond's yield is basically the return you get for lending your money to the government for a set period of time. Think of it as an IOU, where you hand over cash today in exchange for a written promise that you'll get more back later. When yields rise, even though the Fed didn't hike anything, that tells you the market is pricing in more risk and more uncertainty over the long run, sometimes called a rising term premium, exactly the kind of instability that predictable forward guidance was designed to prevent in the first place. All right, quick pause, because I promised I'd keep this brief. If any of this is making you a little uneasy about how exposed your own retirement savings might be to this kind of Fed unpredictability, we've put together a completely free guide on practical ways people are protecting their retirement accounts from exactly this kind of volatility. It's linked below this video, and there's also a QR code on your screen right now if you'd rather just grab your phone and scan it. Totally free, no strings attached. Okay, back to it, because this is where it gets really interesting. To understand why a Fed going quiet is such a big deal, it actually helps to zoom out and look at how the Fed has handled communication in the past, because this is not the first time it's swung wildly from one extreme to the other. Rewind to the Alan Greenspan era, which ran from 1987 all the way to 2006. Greenspan was famous, almost proud really, of being deliberately confusing. He once told Congress, with something close to a smirk, "Since becoming a central banker, I have learned to mumble with great incoherence. If I seem unduly clear to you, you must have misunderstood what I said." Traders used to study the thickness of the briefcase he carried into Fed meetings, genuinely believing a fatter briefcase meant more complicated economic problems, and therefore a bigger rate move coming. That's not a joke. That was an actual semi-serious strategy on Wall Street trading desks for years, because Greenspan gave them nothing else to go on. Vagueness back then was the entire point. The idea was that if markets couldn't predict the Fed with certainty, they wouldn't overreact to every scrap of news, and the Fed would keep maximum flexibility to change course without ever technically breaking a promise. Then came the 2008 financial crisis, and everything flipped. With interest rates crashed down near zero and the Fed unable to cut any further, forward guidance became the primary tool left in the toolbox. Ben Bernanke, and later Janet Yellen, leaned hard into telling markets exactly what was coming, because in a crisis, certainty itself is calming. Investors who know what to expect Don't panic and pull their money out. By 2012, the Fed formalized this into the dot plot we just talked about. And for the next decade, transparency became the religion. Jerome Powell continued it. Markets built entire trading models around anticipating what the dots would say 3 meetings from now. An entire generation of investors came of age assuming the Fed would always tell them what was coming next. So when Kevin Warsh drops the dot plot on day one, he's not making a small technical adjustment. He's swinging the pendulum all the way back toward the Greenspan era of deliberate ambiguity, except this time with none of Greenspan's decades of built-up credibility to cushion the shock. That's the first historical parallel, and it should make you a little nervous because pendulums that swing that hard tend to overshoot. Here's the second one, and it's even more dramatic. Rewind further to October 6th, 1979. Paul Volcker had been Fed chairman for less than 3 months. Inflation in America was completely out of control. Double digits, gas lines around the block, people watching their savings evaporate in real time. On a Saturday night, without the usual advance notice, without the typical Fed choreography, Volcker called an emergency meeting and announced a radical, unannounced shift in how the Fed would operate, targeting the money supply directly instead of gently nudging interest rates the way everyone expected. Traders on Wall Street that Monday morning had no idea what hit them. Interest rates spiked into the high teens almost overnight. Mortgage rates crossed 18%. It became known, half jokingly, half horrified, as the Saturday Night Special. It was brutal. It caused a recession. Small businesses failed. Home builders picketed outside the Fed's headquarters with 2x4s symbolically nailed together to protest rates that had made building anything impossible. But here's the thing, it worked. Volcker deliberately sacrificed predictability because he believed the American public and Wall Street had become so used to inflation that they'd stopped fighting it psychologically. Everyone just assumed prices would keep rising forever, and that assumption itself was fueling more inflation. By refusing to hold markets' hands and telegraph every move, Volcker broke that psychology. It took years and a painful recession, but inflation eventually came down from the high teens to the low single digits, and Volcker is remembered today as one of the most consequential Fed chairs in history, precisely because he was willing to be unpredictable on purpose. Now, I'm not saying Kevin Warsh is Paul Volcker, and I'm not saying we're heading into an 18% mortgage environment, but the logic rhyme is unmistakable. Both men inherited a Fed that markets had grown too comfortable with. Both men made the deliberate choice that certainty itself had become the problem. And both moves, whether you agree with them or not, guarantee one thing in the short term: turbulence. Which brings me to something I want you to really picture, because I think it explains this whole situation better than any chart could. Imagine you're a pilot flying at night in weather, relying on air traffic control. For years, that controller has been giving you constant updates: your heading, your altitude, the planes around you, exactly what to expect for the next hour of flight. You don't love every instruction, but you trust the voice in your headset, and that trust lets you fly smoothly, even through clouds you can't see through. Now, imagine that same controller, on a random Tuesday, goes quiet. Not because there's an emergency, and not because they've abandoned the tower. They're still there, still watching the radar, still fully capable of doing the job. They've just decided, as a matter of new policy, that they're going to stop giving you constant updates, and instead only speak up when something truly requires it. Nothing about the actual flight has changed. The plane, the fuel, the destination, all the same. But you, the pilot, are suddenly flying with a lot more of your own instinct and a lot less hand-holding. You'll probably still land fine, but every bump of turbulence is going to feel bigger. Every unexpected gust is going to make your hands grip the wheel a little tighter, simply because the voice you were used to isn't filling in the silence anymore. That's what's happening to markets right now. The Fed hasn't changed the destination. Rates are still 3.50% to 3.75%. The plane is still in the air. But the constant chatter that investors, businesses, and yes, regular people planning their retirement had come to rely on for over a decade has been deliberately dialed back. And that alone is enough to make the ride bumpier, even if nothing about the underlying economy shifted overnight. Now, hold on. You might be thinking, okay, but the rate didn't actually move. It's still sitting right where it was before this whole silence thing started. So why does any of this matter to me if my mortgage rate and my savings account rate haven't budged? Fair question. Here's the answer. Markets don't just price in what the Fed does today, they price in what they expect the Fed to do for the next 1, 2, 3 years, because that expectation shapes everything from how companies plan their borrowing to how bond investors decide what a fair return looks like right now. When the Fed removes the roadmap, it doesn't remove the destination, it just makes everyone reprice the risk of getting there. That's exactly why the 10-year Treasury yield climbed even without a rate hike. Investors lending money to the US government for a decade are now demanding a little more compensation for taking on that uncertainty because they can no longer lean on the Fed's own guidance to know what the path looks like. That shows up in higher long term borrowing costs across the whole economy: mortgages, auto loans, corporate debt, even if the headline Fed rate stays frozen. In other words, the number that doesn't move isn't the whole story. The story is what happens to every other number that's downstream of the Fed's credibility. And that's a lot harder to see coming because it doesn't show up in a single headline. It shows up slowly in your monthly statement 3 or 4 months from now. And by then, most people won't even connect the dots back to a quiet Tuesday in June when the Fed decided to stop talking so much. Now let's talk about what the institutions, the people whose entire job is to think 3 steps ahead of the rest of us, are actually doing with their own money while all of this plays out, because their behavior tells you more than any speech ever could. In May of 2026 alone, central banks around the world bought a net 41 tons of gold. Poland led the pack, adding 18 tons and extending a buying streak that's now lasted 4 straight months, pushing their total gold reserves up to 614 tons. China added another 10 tons on top of reserves it's been quietly building for years. Uzbekistan and Kazakhstan were buyers too. On the other side, Turkey and Russia were net sellers that particular month. But zoom out to the full picture and the direction is unmistakable. The World Gold Council just completed its largest survey ever, a record 76 central banks responding, and the results are almost startling in how one-sided they are. 89% of these institutions expect global gold reserves to keep climbing over the next year. 93% of central banks now hold gold as part of their reserves. And for the first time in recorded history, gold has overtaken US government bonds as the reserve asset central banks say they'd most prefer to hold going forward. Not silver, not the euro, not some basket of currencies, gold, ahead of the very US Treasury bonds that have anchored the global financial system since the end of World War II. Meanwhile, the Bank of Korea is exploring gold-backed ETFs to diversify its own holdings, and countries that historically had almost no exposure to gold at all, Chile, Guatemala, other Latin American nations, are becoming new buyers for the first time. Think about what that actually means. These are not retail investors chasing a headline. These are the professional risk managers of entire nations, moving some of their most conservative, most heavily scrutinized money away from the debt of the world's largest economy and into a metal that notably pays them zero interest. You would only make that trade at that scale with that much institutional caution behind every decision if you had genuinely started to question the reliability of the paper promise on the other side of that trade. Nobody at a central bank makes an emotional decision. When 89% of them are pointing in the same direction, that's not a hunch, that's a signal. So let's put this all together, because I think when you step back and look at the full picture, the pattern becomes pretty clear. You've got a brand new Fed chairman who, in his very first meeting, tore up 14 years of communication tradition and deliberately chose to say less instead of more. You've got that chairman's own colleagues, the very people setting policy alongside him, split right down the middle on whether the next move should be a hike or a cut, which tells you the uncertainty at the top is real, not manufactured. You've got long-term bond yields climbing, even though the headline rate stayed frozen, which is the market's way of quietly pricing in more risk than the official statement admits to. And running underneath all of it, you've got the most risk-averse, methodical institutions on Earth, the central banks of entire nations, voting with real money to shift away from the dollar's traditional safe haven and into gold, at a pace and a consensus level that's genuinely historic. None of that means panic. I want to be really clear about that, because it would be irresponsible for me to sit here and tell you the sky is falling. And honestly, that's not even what the data supports. The Fed didn't hike rates. The economy hasn't collapsed. The Dow, the S&P, and the Nasdaq are still trading near record territory, even with a bit of nervous chop this week. This isn't a crisis story. It's a positioning story. A story about what happens when the institutions that are supposed to have all the answers start quietly admitting, through their actions, if not their words, that they don't have as many answers as they used to. Which brings me to the three big pieces of the puzzle, because I think this is the cleanest way to see where things actually stand right now. Start with stocks. The Dow, the S&P 500, and the Nasdaq are all trading near historic highs, but they're jittery, moving in different directions day to day as investors try to figure out what data-reactive Fed policy actually means in practice. Then there's gold, sitting right around $4,060 to $4,075 an ounce, hovering near record territory, with silver right alongside it near $58 an ounce, both metals benefiting directly from the exact institutional buying pattern we just walked through. And then there's the dollar and the bond market, where that rising 10-year yield, sitting around 4.53%, tells you that even without a single rate hike, the cost of long-term borrowing in America is quietly climbing, and the world's largest institutional investors are demanding a bit more insurance for holding U.S. debt than they used to. Three assets, three different stories, but all three are reacting to the same underlying cause: a Federal Reserve that decided, for the first time in over a decade, that certainty wasn't worth handing out for free anymore. Before I wrap up, I do want to mention one more thing, because I think it's genuinely useful and I'd feel wrong not bringing it up. If you've got $100,000 or more sitting in a retirement account, a 401k, an IRA, anything like that, and this conversation about Fed unpredictability, rising yields, and central banks quietly rotating into gold has you wanting a second set of eyes on your own situation, we host a completely free one-on-one educational web conference specifically for people in that position. No sales pitch, no pressure, just a real conversation about what diversification actually looks like in an environment like this one. The link is below. And again, that QR code is right there on your screen if that's easier. All right, let's bring this back around. So let me tie this all together. The Fed just did something it hasn't done in this exact way in over a decade. It chose silence over certainty, right at a moment when its own policymakers can't agree on which direction the danger is coming from. History tells us that when central banks trade predictability for flexibility, whether it was Greenspan mumbling his way through the 80s and 90s, or Volcker's Saturday Night Special in 1979, the short-term result is always the same: more turbulence, more repricing, more of that uneasy feeling that the ground under the financial system is shifting, even when the headline numbers stay put. And right now, the people whose entire job is to see that shift coming before the rest of us, the central banks holding a record share of the world's gold, are already moving. Quietly. Deliberately. At a scale that's genuinely historic. The question was never whether something is happening. Something clearly is. The only real question is whether you're paying close enough attention to notice it before it shows up in your own numbers a few months from now. I hope you found this genuinely useful, and I hope it gave you a clearer picture of what's actually happening behind all the noise. Take care of yourselves, keep an eye on your money, and I hope you have a wonderful rest of your day.